So in this video, I'm going to be going over a very popular stock here in Canada. It is one I own. It's one that has rebounded in a massive way from 2023 lows. As we can see here, we're looking at $21 a share. We're nearly a triple that over the last 14 months. And that company is Aritzia. I've held this company for quite some time. We have featured it over at Premium, I believe, since 2018, back here when it was in the $12 to $13 range. And it's a company that reports earnings a bit outside of earnings season, so it's one that I always talk about on the channel because it kind of provides some content when earnings are a bit slower. One thing I do want to say before I start the video, and you're not going to want to skip this because it's a very big announcement, I am going to be doing a debate with TD Bank on their YouTube channel and on this YouTube channel this Thursday. So I'm going to be doing a debate as to whether or not investors should be aiming for total returns versus dividends, whether generating income is beneficial or whether going for total returns is more beneficial. It's going to be a very good debate. I'm sure it's going to be a very, very fun video, and it's going to provide a ton of insights for investors. If you want to watch that video, I am going to be live streaming it on this YouTube channel. So you got to head down below. You have to subscribe to the channel and you will get an alert when we go live on Thursday. It is definitely not one you're gonna want to miss. I'm very honored that they asked me to be the one to debate the total return side of things, and it's gonna provide a ton of knowledge for investors. On the other note, again, down in the description, you can grab 3 stock picks I have for 2025. It's an absolutely free report. You just got to go down to the description to sign up. And as always, like the video and subscribe to the channel. Let's break right into the video. So Aritzia reported its third quarter fiscal 2025 results, and they kind of smashed it out of the park, to be honest. We look to net revenue that increased 11.5%, with comparable sales growth sitting at 6.6%. And when we go to the company's comparable sales growth here, we can see that comparable sales growth, the trajectory over it during the COVID-19 pandemic, interest rates were low, people were locked down, they had a ton of disposable cash, whether that be from stimulus, whether that be from just, overall sitting in their houses, not spending all that much money. We can see that comparable sales growth rocketed for this company. We're looking at 29%, 28%. It was a huge deal for the company during the pandemic, and it was truly a breakout for Aritzia's brand. Now, the one quick thing I'll mention about comparable sales growth, it effectively eliminates new stores. So it will not count new stores in comparable sales growth. All it does is compares existing stores from, say, a year ago to this quarter. So what this does is it gives a better indication of organic growth for a company, for a retailer specifically, because the thing about new stores is they do drive a lot of growth. But if you're only building new stores, that is a very capital intensive way to grow, and ultimately you're eventually going to run out of new store locations. So what you want to see these companies do is not only grow new stores, but you also want to see them growing sales at their existing stores. So we can see that during the 2023 drawdown, what happened in 2023, inflation was high, interest rates were high, disposable income dried up, and people just couldn't find the money for a mid-tier fashion company. I mean, Aritzia's clothing is not cheap. It's not overly expensive. I would put it somewhere in the middle, which is why it's done so well over the last while, but I definitely wouldn't say it's on the cheap side of things. So comparable sales growth slowed during this period of higher rates, less disposable income, high inflation, but now we're seeing that growth return. They reported 6.6% comparable sales growth in this most recent quarter, which is 10 basis points higher than last quarter. But the fact of the matter is we're seeing this project upwards, which is definitely a strong sign. We would not have wanted to see this, the flat or declining comparable sales growth. So they reported that 6.6% increase, and we can see that United States revenue increased 23.6% to $403 million, comprising of 55.4% of net revenue. So when I first bought Aritzia, I believe it was 30 some percent, mid 30% range in terms of US revenue. However, now the company is absolutely exploding in that area. Here's a chart of Aritzia's Canadian versus US revenue, and what you should almost notice immediately from this chart is how tiny this little gray square is at the start of the chart. That would have been March of 2014. Look at it now. We're talking about 68 million to $1.4 billion. We're talking about a 32% compound annual growth rate since 2014 on US revenue. And now we can go to February of 2021. It was 291 million, and we're up to 1.4 billion. This is a material growth in US revenue, and the company is quickly expanding in the United States much, much faster than Canada. Now, somebody might look to this chart and see the Canadian revenue and be, we look to February of 2023, we're looking at around 1.07 billion. And then we look to the last 12 months of 1.12 billion. But the thing here is, the Canadian market is not the growth vertical for this company. The Canadian market is too small. They're already established in the Canadian market. We can see this, 1.1 billion in sales. Their true avenue for growth is in that US market. Why? Well, we have 10 times the population in the United States, plus we have a consumer that is much healthier in the United States, which is what is driving a lot of this growth. The Canadian end of the business is, I don't want to say it's doing bad, but it's really not doing all that good. And that is because we have, I would call it a massive cost of living crisis. And I think I'm being light there. I mean, obviously as a Canadian, you probably felt the pinch. I'm feeling the pinch. Everybody is feeling the pinch. So the US avenue for this company, the growth is huge. It's coming in, as I mentioned, 23% growth year over year. It continues to project upwards. And overall, this company is growing in a market that is generally untapped. I mean, if we go to Aritzia's market cap of around $7 billion, and then we quickly go to a company like Lululemon, which again was a Canadian company that pretty rapidly expanded in the United States. And that was one of the big points of their success. We're seeing a market cap of 47 billion. Now, I don't want to directly compare Aritzia to Lululemon because they are not the same company. They offer a wide variety of different types of products, but I don't really think it's that far-fetched if the brand were to catch on that much that it couldn't hit those market caps. Obviously, that would be over the long term. It took Lululemon quite a while to get there. But I do believe there is the potential for it to get there. So we look to retail net revenue. It increased 10.3% to 486 million. E-commerce revenue increased 14% to 242 million, comprising of nearly a third of the revenue. So when we go to this KPI right here, we can see retail revenue and e-commerce revenue. Again, we're seeing, a big shift in trend here. We look back to March of 2020, we're looking at e-commerce revenue of 226 million. That has nearly 4x'd, not quite 4x, but we're looking at 838 million over the last 12 months. Whereas retail revenue, like in-store revenue, we're looking at 750 million to 1.68 billion. So we're looking at, a little more than a double. So e-commerce revenue is definitely a huge growth vertical for this company. And the one crazy thing is it is still growing e-commerce revenue at a mid-double-digit pace. And this is year-over-year growth comparing the pandemic. So you can imagine how much e-commerce growth surged during the pandemic. And this company is still able to grow over and above that, which is very impressive. So we're looking at gross profit margins. They increased 430 basis points to 45.8%. Margins were a big issue for this company, and one of the main reasons for this was inventory issues. If we go to their financials, we go to the balance sheet and we head down to inventories, this was one of the main reasons why the company drew down so much during the 2022-2023 area. What happened is they had a huge surge in popularity over the pandemic. As you remember, in the pandemic, supply chains were ridiculously complex. Things were taking very long time in terms of deliveries. It was just a complete mess because of COVID-19. We fast forward to 2022, Aritzia took it upon them to order a ton of inventory in order to offset the, demand outpacing supply by quite a wide margin back here. So they ordered a ton of inventory, but the difficulty is what happened, in late 2022, early 2023, inflation started rearing its head, interest rates started rising, people stopped spending, so that inventory builds up. And when you get a retailer like this, what happens when inventory builds up? Well, first off, it costs money to store that inventory. Secondly, you have to mark down that inventory to sell it because the designs, the clothing lines, things like that, they will fall out of style and you will have to mark them down massively in order to sell them. And what do these markdowns do? Well, ultimately, they hit your gross margins because gross margins are ultimately revenue minus your cost of goods sold. If it costs you $40 to produce an item and you can sell it for, let's say, $60, if you have to mark that item down and you have to continually mark it down in order to remove it from your inventory, you're going to have to sell it for less. So ultimately your gross margins are going to take a hit. So they're recovering in a big way because that inventory is normalizing. When we look to selling SG&A expenses, just general administrative expenses, they came in at 29.6% of revenue. That is a slight uptick, but again, revenue, operating margins, gross margins, they're all far outpacing this SG&A expenses. So when we look to adjusted diluted earnings per share, they came in at 71 cents. This is a material increase from the 47 cents it posted last year, and is also well above analyst estimates, which is why you see the company 10+%. We're looking at a pretty big beat on earnings. They expected around 60 cents a share. So that is quite a big beat. Now, the one thing I do want to go over on the growth side of things before I jump into the company's guidance would be their boutiques. So the boutiques KPI is a pretty important one for Aritzia because it will tell you the level of US growth they're currently realizing. So we look back to December of 2013, they had 12 US boutiques. We fast forward that to 2024, they have 51. So we're looking at a 15% compound annual growth rate. Whereas when we look at the Canadian market, we're looking at 42 boutiques and we're looking at 68 now. That's a just under 5% compound annual growth rate. So they are compounding at a more than triple the pace in terms of new store openings in a market that has 10 times the population size, that has a much healthier consumer at this point in time. So again, a lot of people might look at these flatlining Canadian boutiques. We're looking at, 68 in February of 2021 compared to 68 today. They might think that's a downside. The Canadian end of the business is obviously important, but what you want to see is this blue line heading upwards, and it definitely is. We're consistently seeing that growth in the United States, which is ultimately going to help the company grow faster. And the one thing is right now is we have a very weak Canadian dollar. So this also helps because the company is generating US dollars south of the border. So that is certainly helping results as well. So the other thing I wanted to go over was the company's guidance. So if we head down to Outlook, so Aritzia expects the following for the fourth quarter of fiscal 2025. So based on quarter to quarter trend dates, they expect revenue in the $830 to $850 million range. This would represent growth of approximately 22 to 25%, or growth of approximately 28 to 31%, excluding the 53rd week of the fourth quarter last year. So last year they had a extra week in the year that ended up impacting their results. So the company expects gross profit margin to increase by approximately 400 basis points and SG&A 100 basis points. So that would be relatively in line with what has happened this quarter, which would give me an indication that the company is expecting margins, the margin expansion and the SG&A expenses to be relatively stable. So when we look to fiscal 2025, they're expected to grow by 15% from fiscal 2024. This is a mid-tier fashion retailer in a very, very tough economic environment that is still growing at a 15% pace. If we consider the fact that, over the next year, it is likely that interest rates will continue to decline. I know the Federal Reserve said that they're in no rush to lower interest rates, and jobs data came out this morning that kind of highlights that there's not really a huge rush for the United States to lower interest rates. However, I do feel that they will continue to come down in 2025 here in both Canada and the United States. And the more interest rates come down, the more discretionary capital we're probably going to get among consumers. And, they might loosen their wallets a bit and start buying from Aritzia more. So the company has a lot of runway left, in my opinion. Now, with that said, Retail companies are very fickle from a growth perspective and from a market valuation perspective. If we look to the company's valuation, we can see that earnings are trading at 70x. This company is not that expensive. They had a lot of one-time costs. They had a lot of inventory issues last year that ultimately boosted the price to earnings ratio. When we actually look to the price to earnings ratio on a historical basis, it typically trades anywhere from 20 to 25x earnings. Somewhere, sometimes we can get into the 30x range. But the one thing is, in 2023, this company was trading at 16x earnings, despite growing at a 15% pace, and despite, having a relatively untapped market available to it in the United States. This price to earnings ratio, it will normalize moving forward. As we can see, the company posted, like 80% growth year over year on an earnings basis. So that will certainly help it. When we look to a PEG ratio of 0.38, that would suggest that the market is not pricing in a lot of the growth for Aritzia moving forward. And if we do look to their annual growth expectations, we're looking at 2025 earnings to come in at $1.85. In 2026, they're expecting $2.50, which would be, we're looking at 30% plus growth rates in terms of earnings per share in 2026. And when we head to 2027, is $3.18, which would again be high double-digit growth rates. Now, obviously, 2027 is, most of these analysts are completely guessing in 2027. I wouldn't put much faith on those earnings per share numbers. However, we're looking at double-digit revenue growth as well. So the company right now, they're looking pretty good. I don't only plan to hold Aritzia, I will continue to add to this company over the next 3 to 5 years. But the one thing I do want to say is it is a small position in my portfolio. It only makes up, I believe now with its recent run up, it makes up over 3% of my portfolio. But the one thing I believe a lot of people do with these retailers, they get caught up in the growth story, the high projected growth. They take very large positions in these companies, and the volatility can be gut-wrenching, especially when the market feels that the brand might be losing power. If the brand does lose power, that is definitely a possibility. I mean, let's look no further to Nike. Nike has gotten obliterated over the last while here. We're looking at drawdowns from $170 a share down to $71 a share. I think Aritzia's value proposition is a lot better than Nike's. I'm not a gigantic fan of Nike overall. I do believe that is a bit of a brand fallout, whereas Aritzia's, I think these inventory issues were one of the main causes for the drawdown. But I mean, look at this price chart. You have to be willing to buy these companies. You have to stay on top of these companies in terms of trends, in terms of inventory, in terms of overall projections. Because look at this. We look at $56 in 2022. It fell all the way down to $33. And that's what, 6 months later? Then we get back up to $50, and then in November of 2022, and then we fall all the way down to $21 a year later. So if you're going to buy these companies, you got to buy and hold them, but you also can't just buy and hold them and not pay attention to them. And if you're going to buy a position, I mean, ultimately it's up to you. You could take a 10 or 20% position in this company. I mean, I can't tell you how to invest. I keep it within a 2 to 3% range, and I ultimately go from there. That way, if the company does experience some volatility, it doesn't really hit my portfolio all that much, and I get to reap the benefits from a situation like this. So everybody, if you like the video, head down below, subscribe to the channel, like the video, and also remember, subscription is key because we're going to be doing that dividend versus total return debate with TD Bank, along with another dividend investor, a YouTuber, a passive income type investor. It's going to be a great debate. I am on the total return side. I've got a lot of data that backs up the aspect of total returns throughout your investment career and potentially even in retirement. And on the other side of things, he's going to argue the dividend side of things. It's going to be very fun. It's going to be very educational, and you're going to want to subscribe to the channel because we're going to be live streaming it. It's going to be completely live. There's going to be a Q&A at the end. You're going to be able to ask me questions. You're going to be able to ask him questions, and overall, it's just going to be a great time. So we'll see you next time for more great Canadian content.
Thank you.